Hello and welcome. My name is Raj Kamal. In this video, we will cover four topics. We will discuss foundational cost concepts, cost terminology, how costs are recorded, and the relationship of these topics to economies of scale and learning. Let us look at some basic cost concepts. These concepts come from manufacturing but are equally applicable to services or government and not-for-profit organizations with some slight variation in terminology. So when a company buys raw materials or inputs, it creates raw material inventory. This raw material inventory is then used to manufacture products, and the work in progress or WIP inventory includes items that have started being made but are not yet finished. While manufacturing, the company uses direct materials, direct labor, and incurs manufacturing overhead costs. Once these items are produced, they go to finished goods inventory and the costs are recorded as cost of goods manufactured or COGM as long as they are sitting in the warehouse. Once the items are sold, then their cost is recorded as cost of goods sold. On this slide, we will look at cost terminology. Profit is the difference between sales revenue and the costs. So let's take a look at some of these costs. There are costs of goods manufactured, which we just talked about, and then the organization may have non-factory overhead, sales, general, and administrative expenses, for example, SG&A. So combined together, those are the total cost of the organization. If we look at cost of goods manufactured alone, it has two components, as we discussed earlier, direct material and direct labor. Combined together, they are called prime cost. It's just terminology. And then cost of goods manufactured also has factory overhead, which includes indirect material, indirect labor, fixed and miscellaneous costs. Now, if we look at the prime cost, which is direct material plus direct labor, those are also called variable costs because if you don't manufacture anything, you don't incur those costs, which means they are vary by the quantity produced. On the other hand, on the right-hand side, you have factory and non-factory overhead, which are not a function of the amount of products that are produced. Therefore, those are fixed costs and they are then allocated to all the units that have been produced. So we have variable costs, which are directly related to the quantity produced, and we have allocated costs, which are allocated to whatever is produced, but are not directly related to it. The next concept we have is conversion costs. Conversion costs include direct labor and factory overhead because these are the costs of converting the direct material, raw material, into finished goods. So you will see that direct labor comes up in two places. It's a component of variable cost and it's also a component of conversion costs. On this slide, we will see how costs are tracked. As we saw earlier, costs include direct material, direct labor, manufacturing overhead, and SG&A or the non-manufacturing overhead, sales, general, and administrative expenses. The first three are also called product costs, and SG&A are called period costs because you incur them time over time and they're not directly related to the individual products. Now, let's see how they track in the balance sheet and the income statement, two of the three foundational documents and financial statements. So on the balance sheet, you will record assets like raw material inventory, the work in progress inventory, and finished goods inventory. So direct material obviously connects with raw material inventory, and direct labor and manufacturing overhead, including the direct material cost related to the work in process inventory, are tracked there, and the finished goods inventory stays on the balance sheet finally. When items are sold, we recognize sales revenue on the income statement, and at the same time, we also have cost of goods coming in once the sales are recognized, and we also allocate these SG&A. So combined together on the income statement, you have the positive side, which is the revenue, and you have the negative side, which is cost of goods sold and SG&A. Combined together, they give you profit or loss. On this slide, we will talk about economies of scale and learning, and we will start with the terminology of costs. We know that the total cost is equal to total variable cost plus the total fixed cost. And obviously, total variable cost is the variable cost per unit multiplied by number of units. And the acronym we use for total fixed cost is TFC. Now, if we take a look at the average cost, It's basically total cost divided by the number of units we produced, which is equal to the total variable cost divided by Q and the total fixed cost divided by Q, Q being the quantity that is produced. Now, the TVC, total variable cost divided by Q, is obviously the same as variable cost per unit, and the TFC, the total fixed cost divided by Q, is the allocated fixed cost per unit. Now, let's look at economies of scale, which basically pertains to as you make more and more, what happens? So as you scale up, as you increase the scale, as Q goes up, the TFC divided by Q, which means the allocated cost per unit, goes down because now you are spreading the same fixed cost over a larger number of units. So that's how economies of scale operate, and they give you competitive advantage. In addition, you could also have economies of learning, which means an organization, any company, learns from how it works and improves its processes through efficiencies, through, for example, lean approaches where they're taking out non-value added activities in the process. And as quantity goes up, it actually affects the total variable cost. That means you are reducing the total effort going into each unit on the variable cost side. So the difference is economies of scale really operate from the total fixed cost side, whereas economies of learning give you benefits from the variable cost reduction, and combined together they give you what is called competitive advantage. So this is the last slide in this short video, but this really ties the different concepts that we have talked about.